Make sure we are broadcasting here. Yep, looks like we're coming in. Okay, so let's take a look at the market, specifically the U.S. indexes. I'm going to go down to a 5-minute chart to show you what is happening because this market is moving. It's basically two children with cell phones making trillion-dollar swings in the market. So it's never been more difficult, and I guess there's also a lot of opportunity here. But this is the S&P 500 just over the last couple of days. So we opened up Sunday evening right here. Market gapped lower, little relief, pressed lower. So I literally got in the shower this morning and the market was down 1.5% pre-market. I got out of the shower and we were up 2% pre-market. And the news is just a back and forth tweet storm kind of going on. I guess it's Truth Social, but whatever. So Trump puts out a note saying that he's had very productive talks with Iran, that this thing could be wrapped up pretty quickly. On that news, just a massive rally in the indexes, in gold and copper and everything, 3.6% in 10 minutes pre-market, before the big market is even open. So if you had any question on what this market is waiting for this sell-off to end, this is it, okay? That is clear as day, telling you as soon as there's relief from this situation in Iran, this market is ready to run. And we saw that this morning. Now, interestingly, Iran, and it's tough when you say Iran because they don't have a big central figure. They've got several layers of leadership that have been wiped out. They've got the supreme leader, I think that's what he calls himself, no one's seen in 23 days, having things read by a news teleprompter. They got some kind of little military media engine dropping meme video. It's very, welcome to 2026. But anyway, they came back and basically said everything Trump said is not true. And I'll show you here what we just got. Let's see if I can get this open. Okay, so I'm trying to pull this up for you just so you guys know what's going on. And all this has happened in the last 45 minutes. So here we go. All right, so this is an hour ago where he said, I'm pleased to report we have America and Iran have had over the last 2 days very good and productive conversations regarding a complete and total resolution of our hostilities in the Middle East based on tenor, blah, 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 blah. Started the Department of War to postpone any and all military strikes against the power plants, the energy infrastructure for a 5-day period, blank, 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 blank. Okay, cool. All right, good. Making some progress. Maybe 20 minutes later, and I don't have the exact Iran post. I couldn't find it, but this is essentially what it said. They denied everything Trump said. They said there's been no direct contact. He's trying to buy time. He withdrew from power plants out of our firm warning, as if Trump is scared of Iran. That's a good one. He's using psychological warfare. The Hormuz Strait will not return to pre-war conditions as long as this goes on. So basically said everything he said is not true. And that's put a little bit of doubt into this. We've come back just a little bit, but nonetheless, big rally up so far. And every asset, I've been talking about this for weeks, every asset is rallying with it. People are going, why is gold going down? Why is bonds going down? Why is every stock group going down? Because people are just selling everything. And there again, there's the moment. Gold goes from 43 to 4,500. Bitcoin, I'm guessing. Yeah, look at the Bitcoin move. 68,000 to 71,000 in 5 minutes. What on earth do Iranian bombs and military with the U.S. have to do with Bitcoin? Nothing. It's just sell everything. We don't know what's happening. Okay, so I know the last few weeks have been tough. Trust me, I got stopped out in the remaining positions I've got. I'm down like 25, 30 grand on my copper position. I'm not selling it. I believe in it long term. I think I may be early, but I'm not late, but I'm not wrong on this one. But this little dip in copper has been not fun when you own, 50,000 pounds of this stuff or something. I do think it will recover. I think silver will go higher. I think gold will go higher. I think stocks are ready to go higher, as we just saw there in what happened in the immediate 5 minutes after Trump's post. This is just a very tough environment. So Treasury yields Obviously pulled back. Let's go to a 5-minute. Let's look at the 10-year. Yeah, so yields go in the opposite, right? Bonds shoot up, yields go down. It's the same thing. Bonds went up, stocks went up, gold went up, Bitcoin went up. Everything went up at 6 o'clock Central this morning after that tweet came out. So this is a totally news-driven market, which are the toughest ones to trade because it doesn't even matter if you're right or you're wrong. It moves based on whatever Trump fires in his cell phone from bed from the White House. It moves based on what some Iranian put on their Twitter account, and it's very, very difficult. Now, the big driver of this has, of course, been oil. Oil, again, last 5 minutes. Look at that. Boom, 98 to 84 in 5 minutes when this relief showed up. And when you have a global crude oil market trading like a meme stock, it's just not an easy environment. So no matter where you bought or sold crude, you probably got stopped out in the last couple of weeks. It's just from 120 to 80 to 105 to 90 to 100 to 80. I mean, I've just never seen anything like it. So I understand it's been rough. I'm right there with all of you. I promise you, I've other than my short-term swing trade, which I typically risk 7, 8, 10% on, they get stopped out. I've taken those hits. It's part of the game. But I have not cut any of my long-term holdings. Everything I showed in retirement accounts the same. My copper position is the same. I'll show you if you want to see some. If you want to see it, I'll pull this up just a second. But it is just a really, really tough environment. Now, having said that, as soon as this does get firmed up in any kind of way, we're going to see a monstrous rally coming out of this market. The question is, are we going to be in the right spot? And when's that going to happen? And that, unfortunately, is something we just don't know. But we're going to look at the opportunities here, see what we can find, see what the strength is in the market. Yeah, see, all right, only down 23,000 right now on my copper position, but it was like 35,000 on Friday. You know, it's come up a little bit. So now it's not a big drop. We're down 7.8%, which is in the grand scheme is no big deal. It's just it's a decently sized position because I believe very firmly in copper over the next 1 to 5 years going to be a huge market. Okay. TDS, Trump direct. Yeah, look, everyone's got very firm opinions on Trump. It is what it is. He's a guy that's very easy to hate. Some people find him very easy to love. I think if we're all honest with ourselves, and I know some people can't do that, there are things he does we greatly agree with and appreciate, and there are things we really wish he would not do. At least that's the camp I'm in. I think more good than bad comes out of the guy, but do I wish he'd do some of the things he did? No. And if you can't admit when the other team does something you approve of, or if you can't admit when your team does something wrong, that's a problem. And I think that's why we're so divided in here. But nonetheless, we're not taking political sides here. This isn't the View. We're just trying to make some money. CLWOO. I have no idea what this. I don't even have a ticker for that. I don't know what that is. Okay, so let's look at a big picture, and we're going to see where we stand in the market. Now, when you look at the S&P 500, we did close below the 200-day moving average for the first time since May, back when the tariff situation was going on. And it's not as extreme as it looks because we've been in this holding period for the last 6 months. The moving average has caught up and got very tight behind it. So we're only 7% from all-time highs. And if you look at statistics of what the market typically does, did I save that image? Oh, shoot. I had one I was going to show you guys. Anyway, it showed the percentage of years where the S&P falls 5%, 10%, 15, 20, etc. And 5% dips happen in like over 80% of years. 10% dips happen more than half the time. So this is in no way a crash or a crisis. There are areas of the market that are very weak. The SaaS companies, which is software as a service, are getting murdered. Things like OpenClaw and the AI developments are moving so fast right now. We can literally build full-on software applications. It would have taken a team in a year to build in a weekend with an agentic AI bot. And so those areas are coming under pressure. But in my opinion, the place to focus remains on the physical. It is the physical aspects of the market, the things that AI cannot disrupt. We are always going to need oil and energy, especially now with the AI ramp up. We are always going to need copper and steel and lithium and silver and iron ore and all those industrial metals. There's always going to be a place for store of wealth, which is your precious metals and your gold and your silver, not to mention the industrial applications there. And when we look at the areas showing strength, even in this weakness, natural gas, energy, natural gas, energy, solar energy, utilities, energy, gas, energy, natural gas, metals, energy, lithium, metals, energy, metals, right? It's very, very clear the theme that is still working. Yes, we're in a pullback. Yes, things have weakened. No, it has not been fun the last 3.5 weeks, but that remains the theme of the market. And as we've seen over and over again, when the tariffs hit, it's over. We're going into recession. It's all over. 20% drop in a month and a half, and then massive, massive rally. The same thing happened in the 2022 bear market. That thing finally came to an end. Massive rally. COVID, massive rally. This is nowhere near the depth of the dip that we've seen historically. But markets are, for the most part, holding up decently well. Now, one of the big drivers this dip is the tightening of liquidity. So this indicator on the top is the NFCI, it's the Chicago Chicago Fed National Financial Conditions Index. Sorry, couldn't get that one out. And this is a reading put out by the Chicago Fed every Wednesday. And this is all public. Just Google NFCI. It'll take you right in here. And what it does is it looks at hundreds of metrics in the market. And if you want to see what all goes into this number, whoops. Hold on, I'm trying to get this thing to open up. Here we go. It's literally everything. Asset-backed financial commercial paper spread, Moody's corporate bond yield spread, consumer credit outstanding, commercial property indexes, senior loan surveys, 10-year maturity yields, Fed funds rate, credit, jumbo loans, MBA delinquencies. I mean, you name it. All this stuff, all 107 metrics are put into this NFCI, and the job is pretty simple. It is trying to read if liquidity in the market is tightening or loosening. And there's 3 components to this: risk, credit, and leverage. And it all goes together to spit out this one number. Now, what you'll see today is that since so much money is indexed, is passively managed, one of the biggest drivers for the index is not even as much earnings and sales that it is liquidity, dollars being pumped into the market or out. And when financial conditions are tightening, meaning banks are lending less, there's less credit available, it's harder to get leverage and margin, and risk premiums are up, markets will pull back. When conditions are loosening, when money is flowing and rates are down and it's easier to borrow and go on margin, stocks rise. And if you go back and look at this over the last, you can look at 5-10 years of this. Up on the top, when conditions are loosening, i.e. tightening, they're going higher, stocks are going down. When conditions loosen, stocks go up, and vice versa. And when you get these big downtrends in EFCI, conditions are loosening, stocks tend to rally. And so it's no surprise we've had this pullback since, in February and March, as conditions have for the first time, really since April or May, begun to tighten. But the long-term trend of the NFCI is clearly down. If you want an extreme version, this is COVID. Look at how quickly conditions tightened. COVID comes, everyone's out of work. What do banks do? They shrink credit limits. They call their loans. They tighten up the purse strings, right? And then here, the government starts printing trillions of dollars, and it's PPP loans, and it's stimulus checks, and it's government bank support, and they massively loosen conditions, and we just had this historic rally. So as soon as conditions begin to loosen back up again, we'll likely see this continue. Now, this is kind of a tough indicator because one, it only comes out once per week. The other thing is they tend to go back and tweak this. It'll kind of go back and revise the number. So I wouldn't watch for it lock, stock, and barrel, but it is a good idea to keep an eye on the overall trend. And we look at the S&P here versus the advanced decline line. Now you're looking, well, they're going down, Ross. This is not good. Well, yes, this is true. But if we look at how far the S&P is down compared to where it was last, and we look at how far the advanced decline line is down, look at the period here. Whoops. Over the last, call it 6 months, the S&P is pretty much flat. The advanced decline line, however, is significantly up. And what that's showing us is there is actually really good strength beneath the market. In other words, the markets are stronger than they look. And the advanced decline line is a reading of how many stocks are advancing or declining on a daily basis, and it's just a rolling tab. So if you say 1,000 stocks went up today, 800 went down, it's a plus 200 reading, and they add it to the previous day. And so what it does is just kind of show you beneath the surface, because the indexes are so market cap weighted, since your Google and your Amazon and your Netflix and your Nvidia and your Microsoft can drive the market. It's hard to tell, just look at the index, how strong the market actually is or how weak it actually is. And this, believe it or not, is a good sign to me. I'm not saying it means we're going to fly tomorrow, but it shows there's actually a lot of strength beneath the surface. Stocks are holding up better than it appears. And what you want to look out for are the times this is not the case. So we saw the same thing with the tariffs. The big sell-off that happened in early 2025, notice how the S&P index was still way, way down here in May when the advanced decline is already making new highs. That was a lot of strength beneath the surface. We had a massive, massive rally from April until the end of last year. And so when this thing starts to come back, if you see the advanced decline line making new highs before the market, which I believe it will based on what we're seeing, you're going to see a very similar thing. And the opposite is true if you're looking for periods where things are not good. So we look at this one. This is late 2021. Notice how, again, the S&P was rallying, but we saw the opposite from the advanced decline. It was not advancing. And what that showed us was that the markets are not as strong as they look. It is Nvidia and Microsoft and Apple and Amazon and Tesla and Google that are heavily weighted, the big weights for this index, making it look like everything's up. But meanwhile, most stuff is actually not going up. And that was your warning sign that there's weakness beneath the market. And you would have got up very quickly and started to roll over and avoided the 2022 bear market. So this is one of the things I like to keep an eye on. I think it's one of the best breadth metrics for how strong or weak the market is. And right now, the market is stronger than it appears. Now, if instead the advanced decline line was down here, I'd say, well, the S&P's up, but the advanced decline line is down or even. Well, that means the opposite. It means it's not that strong, and a handful of stocks are holding us up. So I think the fact that we've only pulled back 6-7%, despite the fact that some of the biggest market-weighted stocks are down. I mean, Nvidia off its highs, 20%. Microsoft, the second largest company, down 30%. Amazon, since November, down 20%. These are the big players. And yet the index, whoops, the S&P 500 index is only down 7. So I am not overly concerned with the market yet. Now, we could chop around in here a little bit because when you get below the 200, a lot of the algorithmic models go to sell. And I know because I used to build algorithmic trading systems, and the like go-to trend indicator for long-term up and down trends is the 200-day simple moving average. So when stocks or the index close below it, a lot of these systems will not fire. It will not buy new stocks when you're trading below the 200. So the quicker that recovery comes, the faster this rally is going to happen. But in a perfect world, what I would love to see is like a little chop in here for maybe a week or two, a nice little shallowing base right here off the lows, and then I'll be going in very, very heavy on the way back. Okay. All right, let's look at some stocks here. You guys mentioned thoughts on LNG and Mosaic. Yeah, LNG. So, some of this is just like natural gas, crude, especially physical crude. Like my neighbor's a huge oil and gas trader. When I say, I don't mean like he's trading futures, like he's buying it by the tanker. And so he gives me kind of the real rundown. And like, look, we see crude futures get to 118 to 120. Brent crude physical, 150, 160 a barrel. Because this is future delivery. So same thing with natural gas. It's just selling at such a premium because supply is so low. Those guys are printing profits, are printing money. And Mosaic, on the other hand, because the nitrogen shortage, the fertilizer situation being held up in the Strait, is getting hammered. I think these are likely short-term fluctuations. Probably a good long-term buy in here if I had to guess. But these are just going to be very, very, very volatile in the short term. And so it's either like make a high conviction bet with no stop or try to get really, really lucky. I don't think silver will fall today. I mean, silver's down almost 50% from its peak. I bought some more. Last time I bought was here at like 68. Kind of got lucky. That's just a physical I bought. And haven't bought any more since then. It doesn't look ready to. Well, is it gonna rally today? I have no idea if it's gonna rally today. I mean, it's again up big like everything else on this news. $5 an ounce in 5 minutes. If we tighten up here, yeah, could set up another move higher. It's just any single tweet, any Truth Social post, anything from Iran they put on Twitter, wherever the heck they post stuff, is gonna swing. What copper company should I buy now? So the big copper companies, the copper index, just the ETF, CPER. There's 3 or 4 that are kind of your go-to. I mean, Freeport McMoran, FCX is the big one. Southern Copper is another one I like a lot, SCCO. And all these are down pretty big in here. I think you got pretty good buy points in some of these if you're trying to like get a position trade going on, because we had the last real breakout in Southern Copper, as you can see, took place over in here, like in January. Perfect little tightening pattern, breaks out, and we have a retest of that breakout area. So if you're looking to add in or take a new position in some of these copper miners, probably a pretty good place to do that. Right in here, Freeport as well, kind of in this, $45 to $50 range. I think probably pretty good buys. What's the deal with SIIs, the silver miners? Oh, Sprott. Yeah, I mean, Sprott pulled back like anything else, right? Now, Sprott is, we saw some insider buying in this one, which got us into this stock. Now, Sprott is the ETF company that does a lot of the big metals ETFs. So if you look at their ETFs, and if you're not familiar with the ETF model, it's pretty simple, right? We're going to put together a basket of, in this case, copper stocks. You can buy with a single ticker. We charge, 0.75% per year. They make assets under management fees. Well, the ETFs they specialize in are not tech ETFs or crypto or consumer staples. It's critical materials, uranium, copper, lithium, nickel, gold, silver, and gold miners, active miners. So they build the ETFs in what I believe is the big theme of the market right now. And so as that trend continues and as more people, whether it works or not, put money into these ETFs and their asset base grows, they make more and more and more fees. And so we see over here on the right, they currently have $3.46 billion under management. And they make, whatever their fee is, 75 basis points or something on that. So if investors continue to invest in these metals and critical materials, et cetera, via these ETFs, their profits will continue to grow. So I think, yeah, Sprott, very good. I think it's a nice kind of backdoor play on this. UAMY. Yeah, Altimony, I think, is early. It looks like it is setting up. Hold on. There we go. It looks like it wants to set up in here. Notice how after that just explosion, it went 500%. We had the big correction, and see how it's kind of coming in here and compressing. This looks like it is getting ready, to resume its move higher. So I like UAMY in here, especially off these lows. I think a stop at like 680 if you can stomach it would be a pretty good move. Again, it's a metals play. There could be some volatility in the space, but it's look, I think it's a good buy and a good stock in the right area. So I like UAMY here, especially after the 10% dip on Friday. Oh, sure thing, Jack. Thoughts on Ampex? What do they do? Electrical products. Let's see. Lithium batteries for mobility applications, aviation, EVs. Okay. I mean, what a monster. Wow. And I hate going back and seeing these absolute perfect breakout trades that I missed, because if you guys, especially if you're new, this is the kind of backbone breakouts, backbone of the breakout setup we look for. And by the way, I haven't mentioned this. If you guys are not yet members, there is a link there in the chat, or just go to tradewithross.com. But we do have, if you're like trying to get into trading and need some help and guidance, we have a $5 annual membership. It's seriously just $5. We do these live sessions every Monday. There's another one, members only, on Thursday with my analysts. I put out a weekly newsletter. You get access to this indicator. You get access to our team, some bonus reports, tons of stuff for just $5. It's our way to try to help and get people involved and show what's available. But yeah, just go to tradewithross.com. If you do, it'll take you to this page. You can join seriously, just $5 for the entire year. No strings. I don't even think it auto renews. But with lots of stuff in here. There's lots of corny stuff. I don't know why they themed it like this, but it is what it is, But go in there, sign up for that. But these breakout patterns, to me, are some of the most powerful patterns, because once you get this compression and you get this kind of shallowing pattern in a stock, a supply comes in and tightens up, and you buy on these breakouts through resistance levels, that's really some of your best opportunities for these big and fast runs. And this is a great example of, this thing played out almost perfectly. So right there to the breakout, you buy, your stop loss is here. So your initial risk would have been, like 15%. You buy it here, you're up 90%, 100%, in 3 weeks. It pulls right back to the 50-day moving average for an absolutely perfect add-on buy. The stock doubles again over the next 6 weeks, like just as clean as they get. And then kind of rolls over. I'd have been out probably here around 11, 12 bucks a share, but it's a triple on your money in like 6 months. So if we can get these setups again, and notice how this one didn't quite shallow up nice, but we are getting a nice little kind of base shallowing up in here where it's consolidating, could be setting up another run higher. Market is always news-driven, political, or financial. I mean, that's true, Jack. You're 100% right, but we're just on it's like news-driven on steroids right now. DAR, let's look at some stocks. Darling Ingredients, beautiful uptrend. Love this. Consumer durable. See, this is interesting. It's not a strength area of the market, but what a trend. Yeah, this looks great. New stage 2 uptrend, cleared through the last supply level. You're probably clear to 65. That looks really good. HBM, Hudbay. Yeah, so this is another one we bought. You can see that exact breakout. And again, you've got a pretty good retest trade in here. And so what you'll find historically, not always, but historically is if you miss the breakout, meaning we bought here point, what was resistance, like the stock can't get above here, it was resistance until it broke through, will often then become support. And so if I missed the initial breakout buy, especially if it just runs like this, my second favorite place to buy is on a retest. And so this is one where you could take a really low risk entry, buy it here at 1868, put a stop at a swing low, just risking like 7%. And if this is in fact the bounce, which oftentimes it is, you've probably got 30, 40, 50% to the upside on this thing. So yeah, I actually like to buy in Hudbay Minerals here. I think it's pretty good. If you want to see how I'd take it, I'll go ahead and I'm going to take this very, very small. Okay. I'll just buy like 100 shares of this. But all we're testing is to see if that low is going to hold at, what is that? 17.5. So I'll put a stop at like 1740. Okay. So if you buy it here at the market, 100 shares, stop loss, 1740. And if you're brand new, all that means is you're buying it here. If and when that stock falls to $17.40, it will automatically sell it. So unless something crazy happens overnight, my risk is capped at about 6.5 to 7%. I set these orders good till canceled. The options are day, good till canceled, or at the open buy and sell. A day order just means it's good for the day. So if I put a day stop and it doesn't get stopped out today, my stop is gone. I have no protection tomorrow. So I always set these good till canceled. Let's go ahead and buy these here. Again, not taking a lot of risk. I'm risking like $150 in this thing. All right. But this is how I'd take these. And these are like, if you're taking, obviously I'm not trading extremely heavy right now because one tweet, one offhand comment from Trump sends $1 trillion swings in the market. But if I'm going to trade, I'm going to stick to the leading themes of the market, the areas that have shown us the most strength for the last 3, 6, 9, 12-month periods. That's metals, that's energy, minerals, etc. I'm going to buy them on pullbacks to support. Either a clear support level, a previous breakout level, a drop to a key moving average, something in there. And I'm going to try to trade these pretty tightly. You might say, Ross, how are you going to risk 7%? You're going to get stopped out. I very well may. That's why I'm trading small. And if you want my complete honest output, it's this. There are times when conditions are ripe. Everything is good. Every indicator I showed you is marching higher. The themes are clear. I'm going very aggressive there. I'm putting 20, 30% of my account into individual trades. The last 4 weeks has not been ideal conditions. The market is in a downtrend short term. We have news. We have all this. We have oil trading like it's GameStop in 2021, right? So I'm not taking a lot of risk. I'm sizing way, way, way down. I'm kind of just trying to stay in the game. If I lose $100 here, $200, $300, $400 there, like no big deal. I'm really just using this to kind of gauge the market. And if 3, 4, 5, my last little trade start showing some progress, I'll progressively increase my size. Well, yeah, this looks pretty good. We'll see what happens here. UMAC, Unusual Machines. Yeah, this is a tough one. I like the stock. It's just very, very volatile, but I agree. Could be a decent pullback buy. You're kind of flying dark here. There's no real clear resistance other than maybe here to risk about 15%. You could do that on a stock with this strong of a trend. You're talking about a 98 out of 100 relative strength rating. But, it's a mover. But, yeah, if you believe in it long term, absolutely buy here on a pullback to the 50. SOXS, wouldn't touch it. So semiconductor triple bear, meaning you're triple short the semiconductor sector. I don't like triple leverage ETFs, at least not on a trade that's going to last more than a couple days or a week. just because the mechanisms have a lot of expenses in them. And if you held this for 6 months, you're not going to get 3 times the return. Maybe if it tightens up in here, but SOX is a semiconductor ETF. It is rolling over a little bit, but yeah, I mean, look, I think I see what you're going for. If you're going, look, if it breaks through here, if the semiconductor, boom, kind of forms that topping action where it come new high, immediately sells off. Look, it does look like it's rolling over. 1,000% agree. If it then breaks through here, then I would consider a short-term trade in SOXS. And it's probably going to look something like this on that chart, where you'll see it kind of, do something like this and bounce and then come through, and you'd buy it there because it's the inverse. It's short and it's triple short. But with this, if you get a 5% dip in SOX, you'll be up 15 or so percent on this one. Okay. Thanks, Marcus. Appreciate you saying that. What about TPL? Text Pacific Land. Yeah, this looks really good. I mean, we have basically a high tight flag formation here where, you get the huge move, nice, clean, tight flag going higher. Typically, when a body's on a breakout to the upside, it looks very strong. It hasn't done anything for the last, 4 weeks, but it's a really strong sign that it's holding up in here while everything else is rolling over. So, yeah, I like TPL. What might GLD do the next 100 days? So, the biggest thing holding gold back right now is inflation. And the argument goes something like this. Oil is up very big. 12-month inflation estimates, not the number we just got from the CPI reading, but estimates, have spiked to over 5%. If we have 4 to 5% annual inflation, not only will the Federal Reserve not cut interest rates, they could raise interest rates. And if the Federal Reserve raises interest rates and money market accounts go from 2 or 3% to 4 or 5, if bonds go from 3 or 4 to 5 to 6, that becomes more attractive to investors. And higher yields drive money into fixed income instruments, and that money generally comes away from things like gold and silver. And so the thought is the big case for gold is weakening if interest rates rise. Now, I don't fully believe that. I think long-term higher inflation also drives gold higher. I think yes, rates will come up, but the government will continue to spend. The debt will continue to spiral. We spent $2 trillion more than we've brought in just since they raised the debt ceiling, middle of last year. It is going out of control. We're going to be at 40, 50, 60 trillion dollars in the next 10 years in debt. It is completely unserviceable. The U.S. will have to continue to devalue the dollar, print to fill the gaps. And as that happens, that is long-term bullish for gold. So short-term, there is pressure on gold. Long-term, it is hugely bullish. So I'm a firm believer in gold long-term. I have physical gold. I have GLD and gold miners. In my retirement account, notice it right there to the 200 and kind of bounced. I think this is probably a good place to be adding gold, personally. But that's my take. Now, what's it going to do in the next 5 minutes? I have no idea, right? I mean, we can try to trade some gold futures if you want here, see if we can catch a spike. Let's see what crude's doing. Crude's kind of bouncing around. I'm looking for a good, short-term 5-minute setup on one of these. We can take a decent-sized position. Can you check SIVR? Oh, just the silver ETF. Yeah, I mean, very similar. Very similar to SLV. They're going to look exactly the same. Micron looks good. Notice it's holding the 50-day up there. NSP. I don't know much about this. It's pretty ugly chart. I'd have to have some kind of good reason to buy it because nothing about this says higher just yet. Maybe short-term little consolidation off the lows, but it's a pretty massive downtrend you're fighting up against. Gus, why are the commodities down so much? Well, it's just everything's down. And I showed that kind of in the beginning. When you look at the S&P that has fallen off with this war, like it's taken copper down with it. It's taken, well, I'm not going to say crude oil. That's the only thing that's going up. It's taken gold down with it. It's taken silver down with it. It's taken bonds down with it. Like literally everything is selling off. So it's not as if there's a reason for it other than a liquidity crisis. People are just deleveraging, just reducing exposure, just selling everything. So these are the times that are no fun because the last 3 weeks straight up, there has been nowhere to hide. There's been one place to hide, and that is crude oil. And if you had the foresight to say this is not going to end quickly, Iran's going to mess around, it's going to get ugly, you could have made a good chunk of money here in the energy space. Now, it was a wild ride, but you could have done pretty well. Other than that, nothing has gone up. And that's why I say these are not ideal conditions. It's just there's times when things are great and there's times things are not. AirSculpt, medical specialties, 180 million. All right, so we've got a little micro cap stock here trying to consolidate off the lows. I don't know much about it. They're going right into earnings today. Something just happened on Monday with this big volume spike. Oh, they already announced their numbers. No. Maybe they updated guidance or something. The stock jumped 50%. Yeah, 50% jump. It's a wild little sucker. I don't really know. I mean, all I can say is if you get up here above 3.5, you may be onto something, but it's a penny stock making 50% daily swings. It's not really my cup of tea. It's not my specialty. Costco, COST. Yeah, Costco looks fine. I don't see a whole lot if I'm being honest. It doesn't look bad, doesn't look great. I mean, I like that it rallied in January and has come back in a big way. But it's very much just kind of going nowhere in a hurry and has been for the last 16 months. So I think there's maybe better opportunities. If you're asking, should you sell it? No, I don't see any signs. Looks like it's going to roll over. How do I get the advanced decline line SB in my trading view chart? Well, there's two ways. You can build it in there, or I can just give you this chart. Would that be easy, Jack? No, wait, who asked that? Tim? Let's give you this chart. Here, let me see if I can share this with you. Now, my markings are on it, so if you want to go delete my arrows and all, you can. But I'm going to shoot you this link here in the chat. Actually, Derek, you watching this? When do y'all post this? Thanks. Sean, I'm going to send you something. I'm going to have them post this in there for you. And if you click on that link for the chart, it's just going to take you to a page that looks like this. Now, this is mine. I'm already logged in, but all you got to do is come up here and just hit Save Layout. And you can name it ADL or Advanced Decline Line, whatever you want, and you'll have it. Now, it's got all my markings. If you want to go in here and knock those out, you can. But the other way to do it, if you're just trying to build this chart, is have the S&P 500, just an indicator, and just go to Advanced Decline Line right there. Add it on, and it'll just pop up right there. So I changed the colors and all, but anyway, that's it. Viasat, Coal, AROC. Are you going to do some volume profile? Okay. Circle. Let's see what's going on with Circle. Yeah, Circle's come right up to our initial target, which is about, I was looking for like 130, 140. It went right there to 137. That's pretty good. Yeah, look, Circle looks good. I mean, nice little rally off here. My thought was we'd push up into this supply zone, which is pretty much right there we've gone to. So it's probably going to absorb in this for all this supply, all these people that are underwater, September, October, November. And if we can get through there, we're probably back into the 200s. But yeah, I think it looks really good. Great trend. Just massive rally here off the lows. I did a video on this one a couple of months ago, and it looks pretty strong. Revisit TGO. Yeah, Taseko Mines. Again, this is one that just literally everything has come down. I think it's a good place to add in here. You know, you've got this previous breakout area kind of around 5. You've got this big acceptance area kind of 5 to 6. So, yeah, I think right in here is a really good place to add on in TGB. The fundamental story has not changed. Now, do we have a super clean, technical, high probability, risk 6%, make 60 setup? No, not really. But if you're looking to add in a leading copper miner, I think this is a good place to do so. Right here in this kind of $5 to $6 area. LAR moving this morning. Let's see. Yeah, it's up 7%. Lithium Argentina. Oh yeah, little gap and move here. Okay. And again, here's another one, another perfect example. Why I talk about buying the retest. Can you see there? See how, and if you're new to, we haven't gone through the basics. Typically, we start these and go through the stage of the stock cycle, and I walk you through our breakout pattern and the rules and the entry. So if you're joining for the first time and you're overwhelmed, please don't be. I promise this will be easier. We'll do it again next week in more detail. There's just so much news going on this morning. I wanted to kind of just dive right into it. But this is our go-to pattern where we get this, big base, shallow consolidation. We buy right here on the breakout. And then there's the retest. Right there to that previous breakout area. And so this is, again, just one of my favorite places for a pullback buy is on these retest areas right here. Because it was resistance, 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 resistance. Now it's likely support. You had buyers building and building and building and building and building in here. And then they get a second chance to get in. So these can be one of the best places to buy. So any of these that had clean breakouts, you missed it in December, January. Now you've kind of got a second chance to buy a lot of these. And I would encourage people to take advantage. Use a stop. Don't go, ham on this thing. The situation could escalate. It could get worse. But this is a high probability buy point in a lot of these big leading stocks and commodities if you miss the first thing. RCG, are these uranium stocks? Okay, I don't know what the REN fund is. It's a micro cap stock. Finally getting some legs, but I mean, this thing only trades $38,000 a day in total trading volume. So I mean, if I tried to buy this thing, I'd move the market. The one you mentioned was UUU. Is that University Safety Products? I thought you were thinking of 4Us, which is a uranium stock. UUU, I don't know. It's very, very choppy. I mean, you're trading penny stocks. This is a $16 million company. These are stocks you just can't trade with any kind of size without moving markets in a big way. AROC, Archrock. Yeah, Archrock looks phenomenal. Another kind of high tight flag here. Look at that breakout off the lows. And I'm not trying to Monday morning quarterback. I just want you guys to start seeing these when they appear. And you get this downtrend. This is what I'm talking about. I want to see these things consolidate. See how it comes in, tightens, shallows. What's happening is the supply is being absorbed over here. The sells are being bought up, bought up, bought up. And the dips are going shallower and shallower and shallower and shallower because there are fewer and fewer and fewer shares available. The institutions, the big players are gobbling up all that supply. They're buying it all up as people get scared out and shaked out and bored out. And then the stock is then free to run. The same demand's there, but there's less supply. Look at the volume, okay? Look at the trading volume in this 2-month period versus that 2-month period. It's no different. It's not as if there's this massive amount of buying that suddenly showed up over here. It's that all the shares had been absorbed and bought in this area. And that same amount of demand, the same amount of buying sent this stock up 30, 40, 50% very quickly because all the shares, all the 20 and 25 and $20 shares have been gobbled up. The supply shrank. Okay? So that's why these breakouts are so powerful. Now it's kind of trying to hold up again. And I like to kind of bring this down so I don't think, oh, I'm at the top of the chart. You want to put it in perspective. But it's trying to do the same thing again here, right? So we're starting to see signs of this kind of accumulation, and I'm hoping you get a little bit of this in here. That's your ideal buy point. When you get this, it tightens up, it absorbs that supply. Okay, from 26 to 36. Some people want to take their profits and sell. I want to take my profits and sell. Some people are going to get scared and they don't want to let their gain. You got to get that supply out of the way. Then the stock is free to run again. Okay, I don't know why my camera's going in and out. I'm going to have to work with that. Sorry about that. Anyway, so yes, I like our truck. I think it looks good. Long story short. Viasat. Yeah, it tried last week and it wasn't ready. Notice it kind of broke through and was immediately shut down, 11% dip. So it doesn't look quite ready yet, but hopefully it continues to build in here and absorb and get ready for another run higher. It's still sitting within 5% of all-time highs. Absolutely nothing to be scared of. Kinross Gold, my favorite miners. Yep, another one kind of pulling back right here into a good buying area. So notice you had resistance on the initial run, resistance, breaks through, then you got support, then you got support. Just let the chart do the talking. I mean, what do you got to risk here? You buy Kinross Gold, you put a stop at the low, risk 6.5%. You want to buy this one too? Let's put a stop in here. Let's just give it a little bit of room. Put it like 25.60. Okay. We'll buy some KGC. Again, just going to pick up like 100 shares, not trading big. Put a stop at 25.60. Buy some Kinross at the market. All right. We're long KGC. Now, none of these trades are anything I'm betting the farm on. I mean, I'm buying 100 shares. Like, obviously, I'm not trying to impress anybody. I'm not trying to take big trades. I'm just trying to say, look, this is, if it's going to bounce, this is a pretty good area it could do so. And so I'm willing to take a little bit of risk, because if I risk 6 or 7% and I'm right, and we get back going, I'm up 20, 30%, that's a fantastic risk reward. I can get a 3 or 4 R gain out of this thing. Our HBM is up, is it? What are we up? Oh, look at that. See, HUD Bay's working already. Now we took a tiny little position. Let me see what we're up. $38. All right. Well, it paid for lunch. I'm just kidding. I haven't stopped it out yet. But yeah, we'll see if this works. It's starting to. Markets are showing some strength. Stock runs good. Exactly. Jack, you know what you're doing. When analyzing insider trading purchased by corporate insiders, how do you decide which of the purchases are potentially good buys versus some officer trying to drive up the value of the company stock? So, great question, Stan. Here's what I've found. Your suspicion about them trying to drive the price doesn't really happen. They are held to something known as the short swing rule, which dictates that when they buy their stock, they cannot sell it for 6 months. They're forbidden. If they do, if they make any money, the government takes that profit. So they don't like buy in heavily to try to get the stock to jump and get out. They're forbidden from doing so. So if they're buying today in March, they cannot sell that stock till September. So typically they're only going to do that if they believe it's either a good time to buy or you're trying to take advantage of something that's going to come out in the next 6 months and push and hold that stock higher. Now, as far as what we use our criteria to pick those stocks, it's a number of things. They're all just really common sense, but we want to see multiple insiders buying. We want to see insiders that have a good track record of taking advantage of these moves in the past. We want to see rare insider buying. So it speaks to me a lot more if no one of this company's bought in 2 years and 5 guys bought last week. And so, you know, we kind of put the picture together to try to find common sense stuff. But I understand your suspicion. It's grounded, it's valid, but there are laws preventing that. So we just don't see any of that pump and dump stuff from insiders. The only thing similar to that we see is when someone joins the company. So let's say a CEO just gets appointed. All the time, I will see them come in and put $250,000 in their company stock, just like a show of what I call a show of faith buy. Just saying, hey, I believe in this company. I'm putting my money where my mouth is, but it's nothing I trade on. Walk-in bought more CDE. This war will pass. Underlying demand supply. See, that's a healthy attitude. I totally agree. And Coyer's a great one. Yeah, another good I mean, all these are at pretty good little buy points. Like if you come in here to Coyer, you've got, and this was a perfect shallowing pullback. See that it sells off, it compresses, it tightens, it absorbs, it breaks out here. One little retest a week later from 18 to 28. Then it kind of can't break the high, rolls over. Here's our second retest. And when you step back to like a weekly chart and you put the thing in logarithmic scale and you're going, well, that's actually not a very big deal, is it, Ross? I mean, we've gone from $3 to 18 in the last 2 years. It looks pretty small when I back out and even out the scale via logarithmic. When you look at anything that's made a big move, always go to log scale. Here's the difference. Automatic scale, look at the numbers on the side, 4, 8, 12, 16, 20. Every inch, let's just call this an inch, okay? Let's call this an inch. Every inch is $4. Now, when I go to logarithmic scale, okay, these same inches, and like, again, that's an inch, right? The same inches, each one of those is, 30, 40, is the same percentage. And when you look at the scales from 2 to 3 to 4.5 to 9 to 12 to 18 to 20, right? Because it's even, it's every move this high is the same percentage, not dollar mark. And that's why when you look at these, look at Warren Buffett's net worth over time. It's like you'll see this chart, okay? And it looks like his net worth went, and it did in dollar terms. When you put it in a logarithmic scale, it really just kind of went like this because it grew by the same percentage each year. It's a compounding effect. So yeah, I like Coyer here. It only looks like a nasty sell-off in a short-term daily chart. And if I was trading a short-term, it's a different time frame. But if you're trying to play the big picture, I think it looks good. USO is just going to be volatile. I mean, USO is just an oil ETF. It's just going to be whippy. What do I think? I think oil sustains. I think we'll see sustained higher oil prices for the next 6-12 months, for being honest. I don't think we're going to see $60 crude again for a little while. This stuff just takes a while to work its way through the system. Would I bet on USO by buying it up here at one? I mean, I wouldn't personally. Lunar. Yeah, Lunar's tried to go on Friday, kind of pulled back in, but it's bounced back pretty quickly today. So it's still consolidating, but it looks like it wants to go. Wolf, sorry, you mentioned that before. Yeah, Wolf looks really good. It wasn't ready here when it tried, but you have, just look for the price action to be tightening. When you get scared is when it's widening. If it's tightening, that means supply is compressing, right? This is what you want. When it's loosening, that means things are crazy. And I'll give you a great example of this before we go. This is Bitcoin, okay? Now, you can ask my members. They'll tell you. I recommended Bitcoin as a buy up here because it had run, tightened, consolidated, looking nice, and we bought in here. And initially it did great. And then we got to retest it. Okay, that's fine. Nice little add-on opportunity. Okay, let's just walk through this. It bounces off the retest. It made a new high. I said, good. And then immediately shut down. All right, that's warning number one. My position's cut in half. It made a new high and immediately dropped, 5% in a day. I'm cut in half. Now we come down. Okay, it should opt the retest. It didn't. It broke down. Okay, that's warning number two. I'm totally out of this trade by now. I walked away with a 3% gain or something. Okay, it comes back. It's okay. Oh, look, new highs. Maybe I was wrong. I'm not chasing it, but then it shuts down. And if you look at what's happening, see over here to the left. Let me see if I can draw something like. See over here how the action was tightening, right? See over here in this. Let me make it like yellow or something. See, the action is tightening. It's getting tighter and tighter and tighter. Now, look what happened after that breakout. What's the action doing? Well, it's widening. Didn't put it there. Put it like here. It's the exact opposite. Sorry, I'm not doing this very well. But you see what I'm saying, right? It's getting wider and wider and wider. And that's not what we want to see. And so when this happened, this is our initial breakout area. And this is the base low. And when it broke through this base low, retest, and failed again, I knew we were going down. And so at this point, I go look at my YouTube. I did a video, said Bitcoin's going to 60,000. That was my target. And I had a sell order in to get short at right here, 108,000. And it went to like 107.5. I mean, just barely missed it. Because this was the area, right? This was the support. Support here, support here, support here. It broke down. I'm guessing one more retest, and then we go lower. So I missed it just barely because I was being picky. But look, right there to 60,000. Now, how on earth did I pick 60,000? Well, we just went back and looked at the last place it went. Where's the last place Bitcoin found acceptance? Well, it's right over here, right? So I figured we'd go right back over here. And we did. And that's where it again found footing and is now trying to get some legs to it. So nothing I looked at used a single indicator. There's no indicators on this chart. It is green bars and my pencil. And it tells you everything you need to know. You just need to learn to kind of interpret what you're seeing. If it is consolidating and tightening and holding near the highs, buyers are coming in, they're running out of shares, getting ready to go. If it is getting to new highs and immediately selling off, if the ranges are widening, you're getting ready for explosion in a direction. If it starts falling, where's it going to go? Probably the last place it found a crap ton of buyers. If it gets legs and roars from here, where's it going to go? It's probably going to run up here to about 90,000, where it found acceptance previously, chop around, and hopefully it tightens up again, consolidates all that supply, profit taking, runs again, and we get a move up here to 110, 120,000. Bitcoin is one of the easiest things to trade because it trades purely on supply and demand. There are no earnings. There are no sales reports. There's no CEOs stepping down. There's none of that. It's just supply and demand. And so many, I hate Twitter for this reason. When this is happening, oh, it's the whales are manipulating and it's rigged and they do. No, they're not. Nobody wants it, period. If it was in demand, if more people were buying and selling, it would be going up. Don't get personal about this stuff. Don't marry these stocks. Just read what's happening. So where are we now with Bitcoin? Well, let's zoom in here and see. All right, so you have a little bit of consolidation. Now it's still a bit early, still a little choppy. But look, we're getting higher highs, higher lows, higher highs. Hopefully this is a higher low. You know, and we come in and we kind of consolidate a little bit more and we kind of break through this area. We're likely good to 90,000. Okay? So, again, I'm trying to put 10 years of stuff into an hour. I know it's tough. If any of this is overwhelming, don't let it. We're going to go ahead and end the session here because I know we are out of time for our live sessions. But if you have not already, please, please, please click that link. Just go to tradewithross.com. Get signed up. It's a $5 membership for an entire year. Right now, we're doing these sessions live over YouTube. Previously, I got a strike from YouTube. I don't know why for doing these live ones. We're doing them on the TA channel now. If that happens again, these will all be on Zoom only. So you'll have to be a member to get them. But it's seriously $5. Get that. Get the market health indicator. I put out a weekly newsletter every Friday at 6:30 Central. You get access to our support team, a ton of stuff. It's just $5. So click that if you haven't already. And all you members, I'll see you again next week, same time, same place. And hopefully it'll be a very different story, better conditions, and we can start leaning into some of these stock trades, okay?